Welcome to Mississauga Life and Real Estate Podcast. I'm your host, Sean Jaffrey, joined by my co-host, Alex Stakic. Alex, how are you doing today?
I'm very good. Thank you very much, Sean, for your question. I hope you're doing also good today, right?
Yeah, I'm doing good, man. We're sitting at, I think, -1 right now. I was going to complain, but then I realized it's like -15, -20 in Alberta. So I was like, okay, it's not that bad.
Not at all.
At the same time, it's pleasant. I mean, it's bearable.
Absolutely, I agree with you. Absolutely.
And the roads are clean, so that's another plus too. We're not walking
clean
around
and
the
dry
slush right now. Clean and dry, exactly.
Yes.
Okay, great. So, Alex, a bunch of things to talk about. As the markets change and as new information becomes available, we're always trying to kind of update our clients with what's going on. So, what I wanted to do was talk a little bit on a big picture level, and then kind of towards the end narrow it down and really focus on Mississauga itself, and just kind of see where Mississauga stands compared to the rest of the Greater Toronto area. So first of all, let's talk about the mortgage rates. So the mortgage rates rose again end of October. October 26 was the most recent hike. Interesting because right now we're priced above 5-year fixed rates for the first time since 2019. So the variables are coming to the point where they are higher than your fixed. And the last time that happened was 2 years ago, obviously, when we just mentioned. So we're looking at uninsured mortgages at the big banks are now around 5.5%, while the deep discounted rates across all the other lenders through mortgage broker channels are at 5.1%. On that note, I think we are looking and waiting for December 7th. So this is interesting because typically, you hear that Canada kind of falls in line with what the U.S. is doing in terms of rate hikes. Historically, that's been the case. But what I noticed was that in the U.S., the Feds are going to announce their rate hikes December 14th. But here in Canada, we're going to do it on the 7th. So, this is going to be the 7th rate hike this year since the situation started to cool down. So let's see what happens. It's going to be either no rate hike, or it's going to be 0.5 to 0.75. When that happens, obviously, we will talk about that.
Yes, and if you remember, usually variable rates are lower than fixed rates for so many years. Now when we have variable rates higher than fixed rates, you have two different interpretations of this present situation. First one could be variable rates on the short term, 1 or 2 years, are higher than fixed rates on 5 years term because banks want you to grab this 5 years rate, and probably in 3 years, 4 years, prices will go down, mortgage rates will go down, recession will go back to the normal. Actually, they have no recession, but you will be nailed with a high interest rate on the 5 years term, and they will make extra profit in year 3, year 4, and year 5. But another interpretation could be also, if you're looking same topic from different perspective, if banks are giving you right now variable rates higher than fixed rates, banks are naturally expecting new mortgage hikes, and they're motivating you with this scenario to lock with a 5 years fix, because maybe next mortgage hike will be even more than it's now, and it's saying psychology, better grab you here right now, comparing what you can expect in 1 month or 2 months after this mortgage hike. So it depends from which perspective you're calculating. Nobody knows anything for sure what will going on with the rates, but you always have two different opinions about same matter, right?
Yeah, but I think that historically people have always kind of, especially given the prices that we have today, people always kind of lean towards the variable. And I think even with the trend we're seeing right now, with the variable being more than the fixed, I don't see that trend really changing that much. I think going forward, we're still going to see a bulk of the mortgage holders going towards variable.
Yeah, I agree. Absolutely. Only clients who are locking their mortgages on the fixed mortgages, somebody who is 100% sure that in the next 5+ years they do not have any plans to sell property because of capital gains. Of course, if it's not primary residence. If it is primary residence, and again, they don't want to pay some extra penalties, right? Mortgage penalties.
Yeah. Yeah, and you know what the interesting thing is? I don't know if you ever remember hearing this, but, normally, I think the rate was about 30 to 40% of the people when they get into, whether it's a variable or a fixed term rate for a 5-year term, this is like, it's actually been, it's been going on for a long time. About 30 to 50% of the people will actually end up breaking those terms because what they're doing is they're living in a place, situation changes, and then they're able to kind of take the hit on the penalties because, when you break the term, the 5-year term, you do get hit with a penalty and it's substantial. It's like $10,000, $15,000 or more. But they do it because, the way the market's been in the last maybe 10 years, 15 years, there's so much appreciation on the property that the hit really doesn't bother them that much. It'd be interesting going forward, with the because psychologically, there's a big psychological impact on the market because the rates going up, the economy slowing down, inflation going up. Are people going to be willing to take that loss and say, okay, you know what? Even though I have a 5-year term, I'm going to go ahead and break it in 2 years or 3 years because I need to move and it's okay. I'll go ahead and take the penalty. It'll be interesting to see if they're going to be able to handle that or not.
Absolutely agree. Let's see. We are not so far away from that moment as well.
Right.
So we discussed a couple of times about immigration and what's going on with the plans about the immigration. And I remember in one of our previous podcasts we discussed that we already have 480,000 immigrants or 500,000 who came, and year over the year it's over 700. But keep in mind that whatever numbers you're talking about, they're not including non-permanent residents like international students or foreign workers, and their additional force of 200,000 immigrants, and that population will definitely affect with lack of the inventory for the rental market because most of them they're not able to qualify to buy anything. And second, even in 3 years' time, because we are talking now in 2022, and we know plans for till 2025, where the people will move and buy, because we have a rapid lack of inventory on the market in the pre-construction as well.
Yeah, and another thing I'd like to add to that, Alex, is that we keep talking about these impending shortages coming up because we have these aggressive targets for immigration. I think it's 1.5 million for the next 3 years, 500,000 every year for the next 3 years, which is fine. But the problem that we kind of run into again is the deficit of housing, because if we're bringing in 500,000 people to Canada, are we building 500,000, living units, whether it's for rent or whether it's, for somebody to purchase? And there seems to be a gap in that metric there. Another thing I was thinking about was, you're hearing on the radio a lot that we've got this strand of this unique strand of flu that's going around these days. I believe it's called RSV or something, that's really impacting hospitals like crazy as well. I mean, I was in the hospital last month for quite a bit. My son was sick with the flu. And so, it kind of makes you think about these other factors as well. Like, our healthcare system is kind of like on the brink of collapse right now, to be honest with you, like the waiting times and everything else. And we have these people coming in, 500,000, 500,000 people coming in 1 year, and then, 1.5 in 3 years. How are we going to be able to accommodate all of these things? It would be interesting to hear, what our politicians are planning on doing going forward, because this is now turning into a multifaceted problem. Housing has always been a problem. It's getting worse. We're not building enough inventory. And then you have the issue with, healthcare as well. I mean, it's a different topic, but I guess everything is kind of tied into immigration, which I don't know. I think most recently I saw on City TV, there was this blurb, and they said that 75% of the people surveyed said that, Yeah, immigration is a good thing, but we're concerned because where are you going to house these people? We don't have enough housing units. So that's another thing to kind of keep your eye on, see where we're going to go at this time with all of this. So population growth, yes, it's happening. You know, developers are now kind of pulling back on construction with what's going on. So where are we going to kind of find the equilibrium, right? So a report said that the feds are ramping population growth. Developers are being forced to pull back on construction in what is likely setting the stage for another supply crunch in coming years. So residential building permits, they fell around 16% in September. So the builders applying for permits fell 16% in September. That was for all of Canada. Yes. What was worrying was that in Ontario, it was 24%. So less permits being applied for, less intention of building, and we're kind of you know going back to going back to square one, no pun intended, right? So for affordability and all these issues, looks like you know we're not out of danger. What it felt like right now, you know, the interest rates going up, prices coming down. Oh look, we're going towards a balanced market. This might be a very short-lived scenario.
Maybe, but keep in mind, if you're looking for present condition of the pre-construction sales, 189 projects sold 0 units in last quarter, and these 108 projects are 67% of all pre-construction projects in Ontario. What is, you know, pretty serious number. So if I'm in the shoes of the builder, why should I jump in that role right now if I see negative numbers from these calculations you're seeing right now? Of course, they have totally different numbers in their mind and plans. They're building their portfolio for the decades, and most of them there is, you know, serious and know their job much better than we can expect. But you know, from average point of view, it's pretty scary. So 189 projects sold 0 units in pre-construction in Q3. This is something I have never seen. Right?
Yeah, and I think that this is kind of giving. I don't know if you've observed this in the market, but this is kind of giving sellers a little boost in confidence, because the sellers are saying, like, right now, okay, you know what, I understand that the rates have gone up, I understand the market has shifted, it's changed. If I don't get my price for the home I've got listed for sale right now, that's fine. I will relist in the summer, springtime, because the market will rebound. And I think the fact that there's no new home sales, it kind of signals like, hey, we're going to be going towards a shortage. So sellers are pretty confident that, you know what, if it's not happening right now, you know, we'll go ahead and list in spring or summertime. But the demand is still there for housing right now, if you really think about it. I mean, you know, there are still homes right now, and I'm sure, like, you know, we were talking about it where you put an offer in for a client of yours and there were like over 30 offers, right?
Yes.
So the buyers are out there. The buyers are out there. They're ready to go. They're just waiting for good deals. They're waiting for better deals, where the sellers are saying, you know what, some sellers are motivated. Yeah, let's get rid of this. Let's sell this. You know, we'll take it off from the market. But other sellers are saying, you know what, no, I'll relist again and I'll get my price. So the sellers are out there, they want a deal. Sorry, the buyers are out there, they want a good deal. And the sellers are saying, you know what, my price or I'll relist in the summer. So we haven't really seen any panic selling, right? On a large scale, I guess.
No, I haven't seen in resale. I haven't seen something like that. Yeah, and last week, fresh examples I mentioned to you, I put offer for one townhouse, and we got that property for $35,000 less than listed price, and I believe that price is what we got is realistic. But again, during the home inspection and other terms, you know, my clients were not happy to move forward, and it's okay. Property is still on market 10 days past from our initial offer, and agent sent email that he's looking for offers because his seller is really open for negotiation and very motivated to sell. So we are talking about motivation, right? On the other hand, as I told you, Toronto townhouse, 3-story townhouse with finished basement and unit, where visitor parking has to be paid, but I have never seen so far. 33 offers. They hit 33 offers. It's about 1,800 square feet. And I got yesterday information that they had 33 offers, firm deal. Probably today I will have information for how much it sold for. But as I mentioned a couple of times, some certain pockets in city are facing that scenario that you have so many offers. And of course depends how property is presented, how property is promoted, how property is prepared, what is the level of features, benefits, staging, everything matters, right?
So everything matters, and I think price is just as important today as it has ever been. I think if anything,
Absolutely.
you need to be priced very aggressively now because we're no longer in a rising market where if you price, not right, the market will catch up. That's not happening now. So you have to price it just right. At the same time, Alex, I have seen properties where they've been listed for, like, let's just say 1.3, holding offers, and they don't get the price that they want, and then they end up canceling it and relisting for 1.35. So that situation happens too. But in a market like this, very important, along with you presenting the property nicely, staging it, all those things, that you price it just right. Pricing it just right basically means looking at what's happening in the market in that neighborhood and not being unrealistic. Right.
Yes, and usually every beginning of the month, I'm collecting the numbers from Market Watch. Actually, every realtor has access to Market Watch, and to crunch the numbers about year-over-year market data numbers. And I noticed that in Toronto in October 2022, what is the latest Market Watch report, we had 49.1% drop of sales comparing October 2021. So from 9,700 we dropped to 4,961 sales, and average price year over the year dropped for 5.7% from October 2021 to October 2022. And number of listings dropped for 11.6% to 10,390 days. And average price for detached price home down also for 11% compared to October 2021 to $1,372,000. And active listings also reduced for same amount, and days of market are increased to 21 days. I think in October 2021 we had 13 days. Now we came to 21 days. And in September we had 23 days on the market. So we are maybe, in regards to days of market, improving for only 2 days, right? In spite of the fact that mortgage rates are increasing.
Yeah, so we're still looking at 2.3 months of inventory, which is
Yes.
which is still considered average. So by no means this is an extreme market. It's not a buyer's market or a seller's market. We're pretty much a balanced market for the moment. I don't want to talk too much about numbers, but I do have to point these out to you. I know the numbers aren't really that sexy, but sometimes it's a good gauge, right? They always say that you can't manage what you can't measure. So quickly, I just want to talk about Mississauga because you just mentioned Toronto. This will be a good time to talk about Mississauga. Mm-hmm. Mississauga, on average, right? The average price of Mississauga last year in 2021 was around $997,000. This year, $987,000. So we're actually all overall average, we're down about $10,000 compared to last year. We're basically sitting at last year's prices. Sometimes it's good to look at median prices because, in Mississauga, we have pockets where you have homes that are $15, $20 million, and that can kind of skew the numbers. So let's look at median. So median last year in October was $905,000. So everything, if you were to take an average of the condos, condo townhouse, semis, all that stuff, $905,000 last year. This year it was at $900,000. So we're basically, again, we're back at where we were at last year's prices on average and median. Detached is where I saw the biggest difference. In Mississauga, the average detached house last year sold for $1.55. This year, 1.38. So there's a little bit of a difference. Not
Yes,
monumental, but it's there. Median, same thing. Detached median price, 1.44 mil. This year, 1.3. So it went down to about $14,000. Oh, sorry, $140,000. Not a big difference. It was similar for townhomes. I'm not going to repeat it. Condos is where there was a difference, like a significant difference. Okay. Last year, the average price for a condo in Mississauga was $604,000. This year, $648,000. So out of these different segments, condo is coming out as a winner in terms of appreciation on the price. We have a lot of condos. It's not even like we have a shortage of condos in Mississauga. We have tons of them in the Square One area. Now, the median price was at $570 last year, and this year the median price was $603. So on both fronts, condos seems to be doing well. Now, Alex, this is the interesting part, okay? In Toronto, last year, the average price for a condo was $739, and this year, $740,000. Didn't change. It's the same, okay?
Yes.
Median price, same. It was $653,000 last year in Toronto. This year, $655,000. So what it's telling me is that Toronto kind of remained the same, whereas Mississauga condo prices started to go up. If you were to judge the situation based strictly on numbers, it looks to me like people are moving from Toronto to Mississauga, where the condos are on average about $100,000 less. But it's a better quality of life. You have more green space. It's more open. It's not as congested. It's a shifting trend. I don't think we're going to start seeing people going back to Toronto on the same level that we used to like 2-3 years ago, because people are working from home. I mean, people have moved out to London, Ontario, to Kitchener,
Yes.
Waterloo, all those different
Absolutely.
regions. So I think this trend we're going to continue seeing. We might even see at one point, who knows, that Toronto would be on the same level in terms of price with places like Mississauga, places like North York, East York, and so on and so forth, Vaughan, Richmond Hill. So that's the situation. I thought it was kind of unique that, Mississauga, the price for condos has gone up because everything else is coming down. And actually, Alex, I think this is the first time this year where the average price has actually been less than what it was last year, this October, right?
Yes.
So that was an interesting thing that I noted there. Now, I got a question for you. I wanted to talk to you a little bit about the assignment market, because I'm seeing more and more noticeably listings coming up on Facebook Marketplace and Kijiji where people are saying, "Hey, I bought this place for $600,000, or my client bought it for $600,000. Now we're selling it for like $625 because there's going to be fees and commissions and stuff like that. So we're not making any money on this, and we're seeing more and more of this coming up. And the reason why I bring that up is because we don't have numbers on this, right? So
No.
we'll know like what happened in the resale market. We'll know how many new homes got booked, et cetera, et cetera. And when the new homes get booked, they get sold on the resale market. So we have numbers for that. But when a house gets sold privately or on an assignment sale, it doesn't hit the MLS.
No.
There's no way of tracking that, right? We have no way of telling if this is up or down. But from the sources that have these websites or these forums to sell assignment sales are saying that the number of assignment listings have doubled in the last couple of months. All right. So my question to you is this: nobody really knows what's going to happen in the future, right? There's so many different moving parts, interest rates, supply, demand, building permits, etc. How would you know? Like, what would be a telltale sign that it's a red flag, like something is going to happen, or something, it looks like something is going to happen? Like, one thing here that we can look at is the assignment market, right? Where the assignment market, people are willing to, in some cases, people are saying, "Hey, I'll even take a loss of like $25,000, $30,000, right?" That's one. What's another area that, if somebody was looking at, could be a sign of concern for the real estate market going forward, in your opinion?
It's not only risk. It's actually your judgment as the investor from the day one when you invested in the pre-construction. And you absolutely agree with you with the fact that more and more people are willing to sell below even purchasing price from their side, because what is the scenario if they are not assigning the property? They will lose whole deposit, and definitely builder will chase them for damages, and it could be pretty pricey, and we discussed about that a couple of times, right? Right question could be or should be, who will lose the money who invests in pre-construction. It's not rocket science. People who never planned strategically buying assignments, actually pre-constructions, because they had no plan B. What if I have to close? They purchased 2, 3, 4 properties in pre-construction, knowing very well they're not able to close, but they had no idea how to sell, because they were thinking that market will also be picking up. Second, people who do not have saving and do not have any reserve funds that they can jump with the extra funds to be able to close property, and at least to close, and after a couple of months if it is necessary to sell. And at the last, people who also who invested using their equity line of credits. So when you don't have extra reserve funds, when you don't have equity anymore, and even if his bank is asking you to get money back because your property value on the market is significantly less than before, what you will do then, right? Another question, but this question is actually based overall what our expectations are about the defaults, because a few days back I was in AGF. It's a company who is managing a huge investment portfolio in mutual funds, bonds, and they had 65 years of establishing anniversary, and we asked the same question. What is because they have huge analytical data and data analysts who are very well connected with the banks, and we had again very simple question: where you see our market, real estate market and banking system 6 months from now, March or April, and what about foreclosures, and what about power of sales? And they had very interesting opinion. They were saying, we will not have foreclosures and power of sales as expected, because one very simple reason: banks do not want your property, they don't want your product, they will do whatever is necessary to keep you paying mortgages. How bank will manage that risk? Very simple. Instead of paying monthly mortgage, they will offer to you bi-weekly or weekly, so you will significantly reduce your interest portion of payment and help you to come as close as possible to your previous payments you had, for example, 6 months ago. And another tool banks will use is amortization time. It will not be 25 or 30 years. They will give you 60 years, 70 years. Again, that will significantly drop your payment, right? So
is that even possible? 60, 70 years amortization?
Yes, why not?
Amazing.
It is possible.
Right.
So there are tools bank could apply to keep you under mortgage and to pay your mortgage on a regular basis, because they don't want your keys. Simple said.
They don't want your keys to the house, because there was a time in Canada about 30 years ago or so, I believe it was the 80s, where the interest rates were in double digits, 18, 20% or something, and some people were just literally walking to the bank and saying, here are the keys to my house, keep it, I'm going to go rent. So they don't want that happening, and obviously, you know, I think one of the biggest reasons for them not to do that, first of all, they don't want all that inventory, right? They don't want all these houses sitting there dilapidated and need to be fixed up. The other thing is, you know, one of the reasons why people flock to Canada or invest in Canada is because they believe the banking system is sound, and whatever happens, they'll take care of it. So if that situation was to happen here, they would potentially lose a lot of future business and investment into the country. So yeah, lots of reasons for it not to happen. One thing, though, I think would be a telltale sign that, you know, situations not getting better or it's getting worse is your credit card delinquencies, your rates of bankruptcies. If those start to go up, that kind of signals, I guess, to the banks even that, you know, we need to make some changes, otherwise we've got trouble headed our way. So we haven't seen anything significant, you know, in that sense. So you know, thank God for that. But you know, always good to keep your eyes on it. And you know, if there's something like that to be discussed, we definitely will be discussing that here.
And I have one question for you for the very end. If you remember, we had planned to discuss about the books we are reading right now and to exchange some thoughts about the books.
So I am reading right now a book called Atomic Habits. I just got into it actually. Prior to this, I had read this book called Never Split the Difference, and it was probably one of the hardest books I had to read. I couldn't finish it. I read like 25% of it. I put it away for like a month, and then came back to it. I'm like, no, I'm going to finish this book, read another 50% of the book, and then put it away. Finally, I got to the point where I had finished like 90% of the book, and I'm like, I got to put this away. I'm not going to read the whole thing.
Really? It's so difficult.
Yes. It was difficult to read. It was acclaimed. Everybody talks about it. They say it's one of the best business books in the world. If you did and you found it, useful, good for you. It just wasn't. Yeah, it wasn't meant for me. I do a lot of reading, and that was one of the books that's probably the lowest rated book in my library right now. But right now, I'm reading Atomic Habits. Good book. Looks like it's going to be one of those books you want to read over and over again. How about yourself? What are you reading these days?
Yes, I finished Go Giver. Actually, that book I'm reading every year. Probably twice.
I've read Go Giver, yeah.
It's maybe 120, 140 pages. But
Quick
it's
read.
very good, to refresh yourself with the good ideas and concepts and who you actually should be if you'd like to be successful. And I recommend that book really very warmly. And also I started Atomic Habits, really great book. I also recommend whoever would like to change their point of view and how to change the patterns of the life, definitely should read this book.
Yeah, I'm looking forward to reading more of it. But kind of going back to the Go Giver, I really liked the idea of the book, the premise in there, that when you do something, don't always do it for your benefit to gain something out of it. Do it because it's the right thing to do, and just put goodness out there in the world, and eventually it comes back to you. So if anybody hasn't read it, it's a really good book. Go ahead and read it, The Go Giver. Quick read. But yeah, good. Thanks for mentioning it again. I think I'll read it one more time.
Very good content. Absolutely.
Yeah. Awesome. So I think we've talked about a whole bunch of stuff. I think we've covered everything pretty much that we had intended to. And let's wrap it up with that. And I will see you next week.
Absolutely, Sean. Looking forward to seeing you next week. And have an amazing weekend.
You as well, my friend.
See you soon.
Take care.
Bye-bye.